When it comes to investing, one of the biggest debates is between growth and value stocks. Growth stocks promise rapid expansion and higher future earnings, while value stocks tend to be undervalued companies with solid fundamentals and steady dividends. Both have their pros and cons, and understanding which might perform better in 2025 depends on market conditions, economic trends, and investor sentiment. This guide explores the differences between growth and value investing, their strengths and risks, and what factors could influence which style wins in the year ahead. Knowing this helps investors make smarter decisions for their portfolios. In this video, we will talk about growth versus value stocks, which one will win in 2025. So make sure to watch the full video. 1. Understanding growth stocks: high potential, higher risk. Growth stocks belong to companies expected to grow earnings faster than the overall market. These are often tech firms or innovators with exciting products but may not pay dividends. Investors buy growth stocks hoping for capital appreciation. The risk is higher since these companies may have uncertain profits or face intense competition. In 2025, growth stocks might benefit from technological advancements and strong consumer demand, but they can also be vulnerable to market corrections or rising interest rates that affect valuations. 2. Understanding value stocks: stability and income focus. Value stocks represent companies that appear undervalued compared to their fundamentals like earnings, dividends, or book value. They tend to be more established, with steady cash flows and regular dividends. Investors buy value stocks seeking income and potential price recovery when the market recognizes their true worth. In 2025, value stocks may perform well if economic growth slows or inflation rises, as investors often turn to safer, income-generating assets during uncertain times. 3. Historical performance: growth versus value over time. Historically, growth stocks have outperformed value stocks during strong economic expansions in bull markets, benefiting from innovation and increased consumer spending. However, during recessions or market downturns, value stocks have often shown better resilience. For example, after the 2008 financial crisis, value stocks recovered faster, while growth stocks dominated the 2010s. Analyzing these patterns helps investors understand that neither style is permanently better, and market cycles heavily influence which performs best. 4. Interest rates and their impact on growth and value stocks. Interest rates significantly affect growth and value stocks differently. Growth stocks, which rely heavily on future earnings, are more sensitive to rising interest rates because higher rates reduce the present value of those future profits. On the other hand, value stocks with current cash flows and dividends tend to be less affected by rate changes. As central banks adjust rates in response to inflation or economic growth, these shifts can change investor preferences between growth and value stocks in 2025. 5. Sector differences between growth and value stocks. Growth and value stocks often belong to different sectors. Growth stocks are typically found in technology, healthcare, and consumer discretionary sectors, industries driven by innovation and changing consumer trends. Value stocks are common in financials, utilities, and energy sectors, industries that tend to be more stable with predictable cash flows. The sector performance in 2025 will likely influence the overall performance of growth versus value stocks, making sector allocation a critical part of your investment decision. 6. Dividend yields: income versus capital gains. Value stocks often offer higher dividend yields, providing a steady income stream, even if their stock price doesn't grow much. This makes value stocks attractive for income-focused investors, especially during volatile markets. Growth stocks usually reinvest profits back into the company rather than paying dividends, aiming for capital gains. In 2025, if market volatility increases or economic growth slows, dividend-paying value stocks might attract more investors seeking stability and income. 7. Market sentiment and investor behavior. Investor psychology plays a significant role in the popularity and performance of growth versus value stocks. Growth stocks often benefit from optimism and excitement about new technologies and innovations. Value stocks tend to gain favor during times of market uncertainty or pessimism when investors seek safety. Market sentiment shifts quickly, especially with news about economic data or corporate earnings, influencing which style leads the market in 2025. Staying informed about market trends and investor mood can help you time your investments or rebalance your portfolio. 8. Risks associated with growth stocks. While growth stocks offer high reward potential, they come with significant risks. Their valuations can become stretched during hype cycles, leading to sharp price corrections. Many growth companies also have unproven business models or face regulatory challenges, especially in fast-changing industries like tech or biotech. In 2025, growth stocks could face headwinds from rising costs, supply chain issues, or geopolitical tensions, which could impact earnings forecasts and stock prices. Risk management strategies, such as diversification and setting stop-loss limits, can help mitigate losses in growth stock investing. 9. Risks associated with value stocks. Value stocks, while more stable, have their own risks. Companies may be undervalued for good reasons, such as declining industries, poor management, or financial troubles. Value stocks can also underperform during rapid economic growth phases when investors favor growth opportunities. In 2025, if global economic growth accelerates unexpectedly, value stocks might lag behind. Investors must carefully research why a stock is undervalued and assess if the company has a turnaround plan or competitive advantage. Patience is key with value stocks, as it can take time for the market to recognize their true value. 10. Combining growth and value for a balanced portfolio. Instead of choosing one over the other, many investors find success by combining growth and value stocks in their portfolios. This approach balances the potential for high returns with income and stability. In 2025, a blended portfolio can adapt to changing market conditions, capturing growth opportunities while cushioning downturns with value stocks. Regularly reviewing and rebalancing your portfolio based on market trends and personal goals helps maintain the right balance. Choosing between growth and value stocks is not about picking a permanent winner, but understanding which style suits the current economic environment and your personal goals. Growth stocks offer exciting potential but come with higher risks, while value stocks provide stability and income but may underperform in strong bull markets. In 2025, factors like interest rates, sector trends, and investor sentiment will play key roles in determining which style leads. A balanced portfolio combining both can offer the best of both worlds, helping you navigate market ups and downs while aiming for long-term wealth creation. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.